90% of trading strategies fail if you don't understand this one rule. It doesn't matter if you're trading supply and demand, smart money concepts, or even simple support and resistance. There is one rule that is the missing piece and foundation for any trading strategy. After trading for 7 years, understanding this one simple rule is what's allowed me to become a profitable trader. In this video, I'll share how this rule turned my strategy profitable. Then I'll show you live examples of combining this rule with a simple strategy so you can see exactly how I use it in the real markets. Now, in this video, I'm going to be sharing the scalping rule that changed my trading, and this is called the one candle gap rule. And this rule was one of the missing pieces in my strategy, and once implemented the right way, it allowed me to become a profitable and consistent trader. It's important to mention, it took me 3 years to become profitable. Trading is not a get-rich-quick scheme, but in this video, I'll share a simple rule that's allowed me to become a full-time consistent day trader for almost the last 5 years. And the best part is this one candle rule works with stocks, options, futures, crypto, and Forex. So no matter what instrument you're trading, this rule does apply in those markets. And on top of that, for myself, I trade less than 90 minutes every single day. Therefore, I come to the desk around 9:30 a.m. Eastern when the New York Stock Exchange opens, and I typically trade less than 90 minutes a day with the strategy and rule that I'm going to show you in this video. So this one candle helps me find profitable entries. It helps me hold my winners longer because it simplifies market structure and liquidity into one candle. And the best part for myself, there's no more guessing in my trading. I don't feel scared when I'm entering a trade because I have a mechanical and repeatable process that I follow for my own trading. So what is the one candle gap rule? Well, to understand this rule, you first have to understand every candle tells us a story. And this story always consists of one question: who is stronger or who is pushing the markets? Is it going to be buyers or is it going to be sellers? One thing that you have to understand when you're looking to day trade is the only thing that moves the market is volume. And volume is simply the interaction between buyers and sellers at specific key levels. And therefore, with this one candle gap rule, we are using the interaction between buyers and sellers, but simplifying them into only one candle. Now, there's an extremely simple way to understand the story behind each candle. On the left side here, you can see we have a buying candle, and on the right side here, you can see we have a selling candle. You can see the buying candle is green and the selling candle is red. And all these candles simply mean is if you see a green candle on a stock, this means that the price has increased. Because on a green candle, we open up at the body low. The body is simply the shaded area right here for the green candle, and the body is the red area for the sell candle. But when you see a green candle, it simply means that price opened up here and it closed all the way up here, which simply means that price increased. And on this candle, the buyers and sellers thought that there is more demand than supply. And when there's more demand than supply, the price will increase to the upside. Vice versa for the selling candle, we open up at the top and we close the candle all the way at the bottom. This means that price decreased for this candle, and therefore for this candle, there was actually more supply than demand, and this shows us that sellers are in control, therefore making it a red candle. Now, when we're talking about these green and red candles, a lot of people get confused. I want to make it very clear that when you see a green candle, this does not mean that price will go up in a straight line. We can see that only green candles formed. Vice versa, if you see red candles, this does not mean that price will go down in a straight line. As we can see here, price went down completely. However, this is theoretical. Very, very rarely in the real markets will you actually see only green candles or only red candles. But that's not a bad thing because this is where we look to enter. Every healthy downtrend needs a pullback. So as you can see here, we were trending to the downside, and now you can see those green candles forming. So we need to pull back into an area where buyers and sellers believe that the stock has more supply than demand. And if we can find these areas and mark them out before they happen, then we can enter in looking for a move down to low of day, and that's what we want to capitalize on. Vice versa, when we have these uptrends, every single healthy uptrend, it needs a pullback. And therefore, similar to the downside, we will also capitalize on finding where buyers and sellers believe that there is more demand than supply. And if we can identify that and enter on this area, well, then we can look to ride price back to the upside. And this is the move that we would capitalize on. With this being said, this is where the one candle gap rule is implemented. This rule will help us determine where we can enter on a specific trade. In this example here, you can see we have a clear uptrend. All of these are green candles moving to the upside. So where would we have to pull back for buyers to enter in so we can ride the trade back to the upside, but at the same time have the lowest risk but the highest reward? Because if we enter in up here with no plan, this trade may potentially still move to the upside, but long term you will continuously fail because you don't have a repeatable system. So to use a one candle gap, you have to understand that we need 3 candles. In this example, you can see candle A, candle B, and candle C. Now, this is a bullish example to the upside. I will show you a bearish example to the downside later on in this video, so don't worry, you will see both. However, for right now, all you need to understand is we need 3 candles for the one candle gap rule. In these 3 candles, you can see we have the high of candle A here, and we have the low of candle C here. For candle B, we can see price had an impulsive move to the upside in between that candle A high and the candle C low. And therefore, this would be considered a gap. This is where price moved to the upside too quickly and there was no retracement in price. This wick didn't come all the way back down. So what does this tell us? Well, this tells us that this is a bullish gap. Buyers impulsively bought this stock from candle A all the way up to candle C, leaving this bullish gap. In this bullish gap, there is more demand than supply because we move so quickly out of it, and therefore this would be a high probability entry area that we would be looking for. Okay, so now that I've explained what the one candle rule is, there's 3 steps to effectively execute this one candle gap strategy. And I'll try to simplify these 3 steps as much as possible, and then we'll go into real examples using this in the real markets so you can see exactly how it works in real time. Now, as we can see, we have 3 candles here, and we have candle A's high and candle C's low. In between that, we have the gap that we previously discussed. So what we want to do is mark out the high of candle A, and we want to mark out the low of candle C. Once we mark out the low of candle C and we mark out the high of candle A, this area in here is what the one candle gap rule is. Buyers overpowered sellers, and we had an impulsive move to the upside on candle B, and therefore there is unfilled orders of liquidity or buy orders here that if the stock does retrace into this level, buyers will step up looking for continuation back into high of day. Once we can identify this gap here, for step 2, we want to wait for price to retest into the gap. So as we can see here, we move back to the upside, then sellers stepped in, and where do buyers believe that there's going to be more demand than supply? It's going to be in this bullish gap right here. And therefore, when we come back and look for price to retest, this is where we need to show buyers are overpowering sellers, and we do this by reading price action. Now, if you don't understand how to read price action or you're confused about any concept that I talk about in this video, make sure to click the free playlist in the link in the description. It has 10+ hours on exactly how to start day trading, and it covers every single concept that I talk about in this video. With this being said, when we see this retest and we start seeing buyers stepping in, this is where our entry model comes in. For our entry model, we would be entering once we see strong price action. Our stop loss is simply a break below the one candle gap, and our profit targets are going to be back up into that high of day area. It is very important to mention that I typically like to have a 2R trade. A 2R trade simply means that for every $100 of risk that I would put on this trade, so if I'm risking $100 into my stop loss area here, then that means I need to make at least $200 of profit when I do hit my profit target. And as you can see here, this is an A+ example of the bullish gap. We got the gap right here. We had a move to the upside. We came back for the retest. Buyers stepped in, and then we moved all the way back up into our profit target. Vice versa for the bearish gap, we actually mark out the low of candle A because the candle A is on the top now, the low of candle A, and then we want to mark out the high of candle C. And in this range right here, this is called the bearish gap. In this bearish gap, we want to see the stock, of course, move down, come back for the retest. As we can see here, this is the retest candle, and we would want to enter when we see that weak price action. And as you can see, if we entered when we saw that weak price action, we would have been able to ride this trade all the way down into our profit target, making this a fantastic trade for a bearish gap example. So now that I've explained both the bullish gap and the bearish gap and exactly how to use it, this is going to be the most important part of the video. Now I will show you real examples of both the bullish and bearish gaps in the real markets. This way you'll be able to see exactly how I execute the bullish and bearish gap in real time. Okay, so for the first example here, we're on on Tesla, and what we're going to do is combine the one candle gap strategy with a simple strategy. And you can combine this rule into your own strategy as well, but the strategy that I'm going to be using in this video is called the first candle strategy. I have a full in-depth video on this strategy in the playlist in the description that you can watch after this video. But with this being said, for the first candle strategy, all we have to do is mark out the first 5 minutes of the day. Here we can see 1, 2, 3, 4, 5. This is the first 5 minutes of the day on the 1 minute time frame, which means this is the first 5 minute candle. What we're typically looking for is a break above, a retest, and continuation. That is how the first candle strategy works. It is very, very simple. Now, how would we combine the first candle strategy with a bullish gap? Well, as you can see here, when we're moving to the upside here, we have 3 candles. We also see from this first candle here and this third candle here, we do have a big gap, which means that once we broke this 5 minute high, buyers stepped up aggressively, and therefore there's going to be unfilled liquidity near this area. So to mark out the bullish gap, we're going to take the high of candle A, which is going to be this red candle right here, and we're going to bring it all the way up into the low of candle C, which is this third candle right here, and we can simply push it out. As we can see now, we have a much more defined area where we need a retest to happen. We can see that buyers are very aggressive, and therefore if we retest into this 5 minute high plus this bullish gap, this is somewhere where we can take a high probability entry for a move to the upside. So let's see exactly what happens with this example. We see buyers bring the stock back up, and then we come back for the retest. The retest is happening right near the 5 minute high. And on top of that, we also have the bullish gap presented with strong price action. This is a place where we could look for a long position. Our stop loss is simply going to be a break below the 5 minute high on top of the bullish gap. And we will be looking for at least a 2-hour multiple or high of day. This gives us about a 2.62 trade, which means we're simply risking around $1,500 for $2,800 in potential gain. Let's enter into the trade here and let's see exactly what happens. And just like that, you can see we were able to capture this high probability trade by understanding a simple strategy and combining it with the simple bullish gap rule that allowed us to have this high probability entry to the upside. This is the exact same trade that I took live in the Accelerator and Traders Lab, where I live trade every single day. And I trade live in front of hundreds of traders because I want to teach how I implement these rules and systems into the real market. This isn't just theoretical. It took me years of practice and refining to get to the point I'm at today. Now, with this being said, this was the bullish gap example. Let's go to the bearish gap example. Okay, here we are on a bearish example on Nvidia. What we're going to do is mark out the high and the low of the first 5 minute candle. You can see we've already marked that out. So now we can simply go to the 1 minute time frame. And on the 1 minute time frame, all we're going to be looking for is a break below, a retest, and continuation. However, we will also be looking for a potential bearish gap rule. Let's see if that happens. And as we can see here, though it is small, there is a bearish gap rule that's occurred. We can see this 5 minute candle closure would be candle A. We then have candle B, which is this big impulsive candle. And finally, we have candle C right here. To mark out the bearish gap, all we have to do is mark out the bottom of candle A all the way to the top of candle C, and we can simply drag that over. So now we know that this is where that selling liquidity is sitting, as we had such an impulsive move off of this area. So when we're looking for the break and retest, we can be focusing in on the first candle strategy alongside this bearish gap for a move to the downside. Let's see if we get a retest. And as we can see here, we just broke below, and now we're coming with the retest with weak price action because buyers brought it up. However, sellers are closing it below not only the 5 minute low, but also the bearish gap. So this is where we could look to enter into a short position. Our profit target can simply be down at low of day, and our stop loss would simply be a break back above the 5 minute low plus the bearish gap. This gives us about a 4.3 risk to reward trade. This means we're risking about $330 for a potential gain of $1,200. Let's confirm our entry here and let's see exactly what happens. As you can see, sellers did come close here. However, we did not break or have a candle closure above the 5 minute rule, so we would still be in this trade. And as we can see, we were able to ride this trade all the way down from where we entered by understanding the bullish and bearish gap alongside a simple strategy that I execute on a consistent basis. Now, with this being said, if you want more information on exactly how to start day trading from an absolute beginner with strategy, market structure, price action, even all the way to how to set up your trading tools, make sure to click the playlist on screen now. It is a full 10-hour guide going through everything that I've learned in the last 7 years. If you found this video valuable, make sure to give it a like. If you have any questions, put them in the comments down below. Make sure to subscribe to the channel and follow me on Instagram and Twitter for more education, and I will see you next week with a brand new video.